Over the last few years, one thing I have personally observed is our day-to-day lifestyle has become extremely unhealthy. And I'm sure you'll also agree with me. Be it long working hours, constant screen time, no physical activity, outside food becoming a daily habit, high stress, poor sleep, so many factors. While it is really unfortunate as a human being, from an investment and business point of view, it is a massive opportunity for one sector in India. That is hospitals. Today, hospital is one sector that is completely recession proof. No matter whether you can afford it or not, no matter whether your portfolio is up or down, no matter how bad the market sentiment is or how bad India's GDP is, you would still want the best healthcare treatment for your family. No wonder hospital companies have already been a big wealth creator in India. However, in last 1 year, there has been a good correction and consolidation in the Indian hospital sector. And that has again created opportunity for investors. So in today's video, we will discuss two things. Why hospitals are a structural theme for next few decades and how you can participate in this theme. Alright, let's get started. So first growth driver for hospital sector is structural demand tailwind. India's disease profile is changing far faster than most people realize. Lifestyle disease like diabetes, cardiac issue, cancer, kidney failure, and respiratory illnesses are rising every single year. At the same time, India is aging. The population above 60 years is expected to almost double over the next 2 decades. And this matters because older people consume 3 to 4 times more healthcare than younger population. Second driver is severe shortage of quality hospital infrastructure. Just for comparison, today we have roughly 1.5 to 1.6 hospital beds per 1,000 people compared to over 3 in China and 4 to 5 beds in developed market. So there is going to be massive requirement for quality hospital infrastructure in India. Third driver is insurance penetration is a big structural booster. Health insurance in India is still underpenetrated, but with increasing awareness, more and more people are opting for health insurance. And when people are insured, they opt for better hospital. They don't delay treatment and they choose higher end procedures. Again, very positive for hospitals. Then fourth driver is medical tourism is an added optionality. Today, India offers 60 to 80% lower treatment cost compared to developed markets. We have globally trained doctors, English speaking ecosystem, so that again helps in growth. Then fifth driver is fragmentation. India's hospital sector is still highly fragmented and dominated by small standalone hospitals. Here please note that running a hospital is not easy. Today, listed hospital players have much stronger balance sheet that allow them to expand faster, add new hospitals or beds and invest in technology, while also giving them easier access to capital at lower cost. So over time, the hospital sector would see more and more consolidation and growth of established hospital chain. Now the next question is how to participate in this hospital theme. Let's discuss it. So broadly there are two options. First option is investment in individual stocks. Now there are many great hospital companies that are listed in Indian stock market. Just to name a few, we have Max Healthcare, Fortis Healthcare, Apollo Hospital, Narayan Rudhyalaya, Krishna Institute of Medical Science, then Esther DM Healthcare, Global Health, Rainbow Children Medicare, Dr. Agrawal Healthcare, Jupiter Lifeline Hospital and Yatharth Hospital. So you can deep dive and identify the hospital that you find most suitable. Here please note that you can't just look at revenue and profit growth while shortlisting a hospital stock. Hospitals have a few important KPIs that you must know while analyzing the company. First KPI is ARPOB, that is average revenue per occupied bed. If a hospital ARPOB is increasing, it indicates that the hospital is improving its services in terms of more complex surgery, higher end procedure and so on. Then second important KPI is occupancy rate. That is percentage of hospital beds that are occupied by patients. Today, a major chunk of hospital expenses are in fixed cost. So when the occupancy increases, the fixed cost does not increase in that proportion and hence profitability improves sharply. Third KPI is EBITDA margin. It tells you where the hospital is in its life cycle. New hospitals typically operate in low margin due to underutilization, while mature hospitals should show steady margin expansion as operating leverage kicks in. Please note that if EBITDA margin is flat or declining, it can be a warning sign. Then fourth KPI is ROCE, that is return on capital employed. Since hospitals are extremely capex heavy, building and equipping hospital requires large upfront investment. So over time, returns on that capital must improve. A higher ROC indicates efficient capital deployment. Fifth KPI is debt level. Debt taken for expansion is a natural part of the hospital business. But excessive leverage can hurt the cash flow and limit the flexibility during downturn. The best hospital operators grow steady without stretching the balance sheet. Then sixth KPI you should track is the payer mix. That is, what part of hospital business is coming as cash from patient or insurance or government scheme. A higher insurance and cash contribution from patient generally improves the ARPOB and payment predictability. But if the hospital has high dependence on low margin government schemes, then its returns would be capped. Then seventh KPI is cash conversion ability. Cash conversion tells you how quickly and how much of the reported profit actually turns into cash in the bank. A hospital can show good EBITDA or PAT, but if cash is stuck with insurer or government scheme, the business still feels stressed. A healthy hospital should convert 70 to 90% of EBITDA into operating cash flow over a cycle. Finally, you need to look at future growth plans in terms of new bed capacity addition. If the hospital is adding a higher percentage of bed, it means the growth can be much higher in the future. Based on all these KPIs, I have collated this comparison among top hospitals of India. Hope it will help you shortlist the right hospital stock. Now, only catch with individual stock picking is it can be very confusing. I mean, which hospital should you pick? Plus, you need to monitor the development closely. A lot of you might not get so much time for all this. That's where you have second option, that is ETF route. There are not many hospital ETFs in the market today, but recently, Grow Mutual Fund has launched BSE Hospital ETF. With this ETF, you can participate in hospital sector growth that would have a direct exposure to BSE Hospital Index. Please note that there's an upper capping of 20%. So no hospital can have more than 20% weightage in the index. And it gets rebalanced semi-annually. Just to give you an idea of BSE Hospital Index return versus Nifty 50, it has outperformed Nifty 50 by a huge margin over last 3-year, 5-year and 7-year time frame. However, before investing in hospital ETF, please note that no sector is risk-free. First risk with hospital is regulatory risk. Healthcare is politically sensitive topic. There could be price cap on procedure, medical device, insurance tariff, or higher regulation can hurt the margin overnight. This risk never goes away. Then second risk is higher capital intensity and long gestation. Hospitals require heavy capex upfront and takes years to break even. And any ramp up or doctor hiring or occupancy can drag return for longer than expected. Then third risk is doctor dependency risk. Star doctors drive patients' flow. If key doctors leave, revenues can drop quickly. So retaining top medical talent is a constant challenge. Then fourth risk is execution risk and expansion. Adding new hospital or beds sounds great, but poor location choice, wrong case mix or slow ramp up can dilute the ROCE. Then fifth risk is leverage risk. Expansion is generally debt funded. If cash flow does not ramp up as planned, then balance sheet can get stretched. Finally, sixth risk is valuation risk. Hospital stocks often trade at premium valuation due to their long-term visibility. So if growth slows even slightly, stocks can correct sharply. Overall, if we conclude, hospitals offer a structural growth story in India due to lifestyle issues, aging population, insurance penetration, and infrastructure shortage. If you are willing to track businesses closely, understand hospital-specific KPIs, and stay invested through phases of expansion and consolidation, so in that case, you can pick individual hospital stocks. However, if you don't want the complexity of stock selection and monitoring, the ETF route gives you a clean and diversified way to participate in this long-term theme. For that, you can track the recent NFO of Grow BSE Hospital ETF. That said, before investing your money, ensure that you also understand all the key risks with hospital sector. So that's it for this video. Now you tell me in the comment, are you participating in this hospital theme? And which is your favorite hospital stock? If you find this video useful, do share it within your circle. I'll see you next video. Till then, take care.